So as you go on this investing journey, one thing you learn very quickly is that investing is a whole lot less that has to do with the numbers and the figures and all the other mechanical things that go into investing, and a lot more focused on the mental side of investing. It's a lot more focused on how you process information. It's a lot more focused on how you're taking in information and how you're seeing the markets as a whole. It's a lot more about your mental state and your mindset when you're looking at investment and looking at companies. And in order to help me understand and to learn more about the mindset to have when it comes to investing, I've been binging Howard Marks, and I've been binging a lot of the stuff that he's written. This was a recommendation from one of my good friends, Tolu from Tolu's Notes. By the way, go check out his newsletter. I'm going to put a link down in the description for you guys to go check out. He writes amazing stuff, but he shared Howard Marks with me. He shared a couple of books by Howard Marks with me, and he shared this podcast, The Memos by Howard Marks, which he's releasing a lot of the older memos that Howard Marks has written in the past, and he's just re-releasing them and reading those out. And so I was like, yo, let me get into this. And there's so much great information. I'm gonna leave a link to this as well in the show notes. But there was one that I was listening to. It's called It Is What It Is. And in the memo, he just goes through something he calls the poor man's guide to market assessment. And I just saw the assessment and I was like, yo, this is an amazing way for us to be able to think through the market as a whole. But more importantly, it's even better for us to use this, a slightly modified version of this for us to use when we're looking at businesses to ensure or to help us know, should I be investing in this business? Is this business overvalued? Is it undervalued? Am I taking risk when I'm investing in this business? But of course, you're always taking risk. But it just put it in such a way that I was like, yo, I love the way that he broke this down, and I have to share this with everyone. So in this video, we're going to be going through the poor man's guide to market assessment, and we're going to do it for the market as a whole. And then we're going to do it for two different companies. We're going to do it for Intel and we're going to do it for Google, which are two of the companies that right now I have my eyes targeted and I'm looking at and saying, yo, these could be two great investments that I can be making right now. So if you want to check that out, if you're ready for that video, let's get this thing started. Alright? Whoosh. What's going on, people? It's your boy Kalechi back with another video. If this is your first time around these parts, hit that subscribe button. If you enjoy anything that we talk about on this video, hit that like button. Turn that thing, say with me now, blue. But anyway, like I said at the beginning of this video, we're going to be going through the poor man's guide to the market assessment. It's just a quick little table that Howard Marks just talked about when he wrote the memo and also talked about in the podcast. And I was just sitting there and thinking, yo, this is perfect. This is something to help each and every single one of us when we're just thinking about the market as a whole. But even more importantly, and we'll get into that, is how we should think about individual stocks as well. So let's get right into it with no more further ado, and let's get right into the information in this. So we'll do the general market assessment to start off with. So in the general market assessment, it starts off with the economy. So how does the economy look right now? Is it vibrant or is it sluggish? And I would say that the economy right now is actually pretty vibrant. People are willing to spend more and more and more money as we're coming out of this pandemic. Over the weekend, I know I traveled. I saw a lot of people traveling. So the economy as a whole is looking very vibrant right now, even though we are coming out of a pandemic. On the next one, it says outlook, positive or negative. The outlook right now is looking very, very positive. Lenders, are they eager to lend money? Are people eager to lend money? Or are they reticent of lending money? And right now, if we look everywhere with the amount of mortgage loans that we're seeing, everybody can get money for the most part. So they're eager to lend money. So we'll mark that one. Capital markets, are they loose or are they tight? Right now, it seems like anybody can kind of raise capital. We've seen the highest rates of IPO in all of history. Like the amount of companies that are going public, and then also we've seen the highest rates of SPACs that we've ever seen in history. So I'll say capital markets, very loose right now. Capital is extremely plentiful. People are ready to deploy their money and give their money to different companies. They don't even care what it is. They're trying to get that money. So very, very plentiful. We'll go with that one as well. Terms. Are the terms of the capitals being raised, or is it easy or is it restrictive? Now, this one is hard for us to know because we're not money managers. We don't know the insides and outsides of how people are lending those things. But I'm assuming that the fact that it's so easy for people to raise capital right now, I'm going to say the terms are very easy. Interest rates, of course, everybody knows this one. Interest rates extremely low right now, historically low right now. Next one is the spread of the interest rates. I don't even know what this really means, so we're just going to leave that one alone because I'm not sure exactly what it is. I'm just going to highlight that one as neutral because I'm not sure exactly what it means. Next, investors. Are investors optimistic or pessimistic? Right now, if you talk to anybody that's investing, they're ready to put the money in the stock market. They're ready to put money in crypto. They're ready to deploy money. So investors are extremely optimistic right now. Investors, sanguine just means like extremely optimistic. I didn't know what that meant. I had to go look it up in the dictionary, but it's like, are they extremely optimistic or are they distressed? Again, extremely optimistic. Are investors eager to buy or uninterested in buying? And right now, everybody's ready to buy stocks. Everybody's ready to buy everything. So eager to buy. Asset owners, are they happy to own or are they rushing for the exits? And everybody knows the answer to this one. Everybody is happy to hold the stocks that they have right now. Nobody trying to sell. Sellers, not that many sellers. Very few sellers. So we'll go with that one again. Markets, are they crowded or starved for attention? Right now, it's the hottest thing. Like, you're the coolest person in town if you know anything about investing in stocks, investing in crypto, investing in real estate. If you're a guy, if you just put investor next to your bio on Twitter or on any of this thing, you're the coolest guy ever. I mean, so much so that now it's almost as cool to be an investor as it is to be like a musician or anything like that. So it is extremely crowded. Funds. This one is hard for us to know because, again, not a money manager, so I don't have access to this information. But for the most part, it feels like, are they hard to gain entry to? I would say no, because of the different technologies that are coming about. Everybody is able to buy into an IPO. Everybody is able to invest in ETFs and those kind of things. So I'll say it's not hard. It's open to everyone, basically. Funds, new ones. It feels like every single day I'm seeing a tweet about a new fund, a new person raising some kind of capital. So again, we'll go with that one. GP, I don't know what this means. GPs hold the cards on terms or LPs have bargaining power. I think it's something about the business, the limited partners in the business hold the power, or the people who are given the money hold the power. And I'm not sure of that one because, once again, I'm not a money manager, so I can't answer that question. We'll just go neutral on that one. Next, recent performance. Recent performance of the stock market. I mean, after we lost 35% last year, the stock market has doubled. The S&P 500 has doubled in the last year. Just think about that. The S&P 500 has doubled from its all-time lows. Think about that. So, recent performance, extremely strong. Asset prices, extremely high. Like, everything is super expensive. Real estate is expensive. Stocks are expensive. Well, crypto just got shellacked, but everything is super expensive. Gold, everything is expensive. Diamonds, art, everything is so expensive right now. Prospective returns. And because everything is more expensive, guess what? Your returns are possibly and probably going to be lower. So we'll go with that one. Risk of investing. Is my risk high or is my risk low? Right now, the risk in investing is high because there's a lot more potential of losing, because the higher you go, the more likely it is for you to fall. So risk of investing is high. Popularity, qualities. Right now, everybody's extremely aggressive. Everybody's trying to invest in the next niche thing. Everybody's trying to invest in the next SPAC. Everybody's trying to do all of that. So it is extremely aggressive. After that, the right qualities. What are the right qualities that people should have right now? Should they be cautious and show discipline, or should they be extremely aggressive? Caution and discipline is where people should be right now. Next, so should they be selective, or should people just be investing in every single thing? I'll say right now, because of where the market is, we should be extremely selective about the stocks that we're investing in if you're the type of person who tries to pick stocks. Otherwise, just investing in the broad index fund right now. So I would say extremely selective is what we should do if we're trying to pick single stocks. Available mistakes. Buying too much or buying too little. I'll say our available mistake in the market as a whole right now is buying too much. It's buying too much. When you're at an all-time high, that's not the time for you to be deploying capital, like all the excess capital that you have, because you're at an all-time high. I'm not saying that if you have some money on the side, you shouldn't deploy that capital to invest in the broad market as a whole, especially if your time horizon is extremely long. But if you're picking single stocks, you can get into the business of buying too much, especially for some of the companies, as we'll talk about in a short while. The next one is are we going to be paying up? In other words, asset prices, like we said earlier, are expensive. So are we going to be paying more for the same thing or less? So right now, everybody's paying more. And then finally, are we taking too much risk, or are we taking not enough risk when we look at the market as a whole? And right now, the possibility is most of us are probably taking more risk that we need to be taking, because this is not like shooting fish in a barrel like we were doing during the COVID crisis. This last year, you needed to take a lot more risk because every single thing that you were buying last year was going up. So you could take any kind of risk that you wanted to take at the end, during the pandemic last year, and you are going to do well. So when we look at the market as a whole, automatically, when everything looks like this and you get to the risk aspect of things and you're like, wait a minute, like this should make you cautious. This should make you go, wait a minute. Maybe I shouldn't just be like putting all the money that I have, deploying every single thing every single time in every single stock. Maybe I should be more cautious in the way that I'm approaching my investment. And this is an awesome way for us to just be able to think through the market as a whole. Now, this does not mean that you don't make investments. This does not mean that you don't go searching for things to buy or things to invest in. This just means that you need to be more cautious. You need to be more careful in the things that you choose to invest in. So that's the market as a whole. By the way, I'm going to share this spreadsheet in the description. If you want to go download this for yourself, it's going to be down there for you to use for your own research purposes. But anyway, I took this entire thing and I broke it down into a little bit more specific one for individual stocks. And we'll start off with just looking at Google. This is my Google DCF Excel spreadsheet where I do all my DCF for different companies, but this is Google's own. And right now I see Google has a 26% upside based on my discounted cash flow, with growth rates for the next 5 years being about 10 to 20%. I added this in here and I broke it down and I made it a little bit smaller to be more specific to Google. So if we look at the economy again, the economy right now is still vibrant. So we'll select that as for Google. It's vibrant. The outlook for Google right now is extremely positive. It's extremely positive for Google. Debt, if we go back to this one, I changed it from lenders to debt because that's what's more important for an individual company. And so on Google's front, we look at the debt load. Google has very low debt. So debt is very low. We like to see that. We select that one. Spread is the spread of Google when the ask buy spread. At least that's the way I'm looking at it. Is it high or is it low? Is it narrow or is it wide? Right now, the ask and buy spread for Google is extremely narrow. So we'll click that. Investors are extremely optimistic about Google. That's why it keeps on flying. We'll click on that one again. Are investors eager to buy? Yes, everybody wants to buy Google. Google just keeps flying higher and higher and higher. Everybody's excited to buy Google. There's not really any negative news associated with Google right now. Asset owners, people who own Google stocks, they want to keep holding because it's been good to them. They expect good things to keep coming. Nobody's trying to rush for the exit. Sellers, very few, like I said, because people are still trying to buy. The stock market for Google right now, everybody likes Google. Everybody uses YouTube. People are buying Google very heavily, especially because of the ad dollars that they keep bringing in. Next, the performance for Google in the last year, Google has outperformed most of the other FANG stocks. So it's been very strong. It's been extremely strong for Google. Next, perspective. It is very possible that Google will have lower returns moving forward. So we're going to click low for that one. Next, we're going to look at risk. Is the risk involved in investing in Google high or low? In my opinion, the risk of investing in Google is kind of low because it's an established business. So we're going to go with low on that side. Next, we're going to go look at popular qualities. A lot of people who are investing in Google are extremely aggressive right now with investing and buying more Google. Next, should people be more cautious and disciplined? It's hard for me, but I'll say yes, that we should be a little bit more cautious because Google just hit all-time highs. That's not exactly the time for you to be buying a stock. Well, then again, who knows? I mean, usually when a stock hits all-time highs, it usually hits another all-time high sometimes. So I'll still say be cautious and be very disciplined about when you're buying it. Then finally, what are my mistakes that I can possibly make when I'm investing in this business? Is it buying too much or buying too little? I would say buying too much because, like I said, if I'm supposed to be cautious rather than disciplined, it means that my risk is buying too much. An available mistake is paying up. It's paying a premium for Google stock because it's such an established business. So that's my available mistake to make there. And then finally, is it taking too much risk or too little risk? I think with Google, it's taking too much risk. So once you look at this mindset, like the mindset I should have going into Google is, maybe I should take my time. Maybe I should make sure that I'm turning every stone and I'm making sure that I'm looking deeper into this company, that because this is not like a easy buy, like it's not like shooting fish in a barrel where it's established that this business is definitely going to get the returns that I expect for it to get. But yeah, so that's generally just like a quick way for you to just look at a business and determine, like, should I buy this business? Should I not buy this business? How does the economy, the market as a whole look? Does it look good? Does it not look good? It's just a quick way for you to be able to break that thought down. And I just thought that it was so awesome when I read and listened to, I actually didn't read it, when I listened to the memo by Howard Marks. It was such a good listen, and I'll just put that in the description below for anybody who wants to go check this out, because it was so good to listen to him talk about all these different things. But anyway, that's all I got for y'all. I hope y'all learned one, maybe two things out of this entire thing, and if you did, hit that like button. If you loved it, hit that subscribe button. I'm gonna catch y'all up on the next one. Remember, generosity is always greater than greed. God bless each and every single one of y'all, and I'm out. Peace. Whoosh.